Imagine you've saved $1.7 million for retirement, but every time you and your spouse talk about finally calling it quits, you both freeze up with the same burning question. How much can we actually spend without running out? Today, I'm showing you the exact 3-step framework that took Bill and Tina, who had that same fear, from spending paralysis to knowing exactly what they could afford. What they discovered completely flipped their understanding of how retirement spending actually works. We'll cover our 3-step process: getting clear on what they want from retirement, building the plan to fund it, and testing real scenarios. That 3rd step is where everything changed. They went from second-guessing every spending decision to complete clarity about what their retirement could look like. The example I share today is adjusted to protect our clients' privacy, but you can apply the same framework to your situation regardless of your numbers. Let's meet the couple this plan was built for. Bill and Tina are both 60 years old. Bill has built a solid career as a construction project manager, but after decades of physically demanding work coordinating job sites, his body was telling him it was time to step away. They weren't asking whether they could afford to retire in 5 years. They were asking whether they could afford to retire at the end of this year. Here's what they built over time. You can see how their assets are spread across different types of accounts. Bill's 401k at Fidelity has nearly $1 million. His Roth IRA adds another $150,000, money that's already been taxed, so every dollar of growth from here forward goes straight into their pockets. Tina has a traditional IRA with $300,000, and they have $300,000 in a joint taxable account. Their home is fully paid off and valued around $600,000. In total, that's $1.7 million in investment accounts. Their $2.3 million total net worth includes their debt-free home, but the $1.7 million in liquid investments is what would fund their retirement. From the outside, it looks solid, but having money and knowing how much you can spend are two different things. Could their $1.7 million actually support their vision for 30 plus years? Bill and Tina came to us wanting to explore retiring at the end of the year, just 6 months away. For many people, retiring at 61 is considered early, since it's 4 years before Medicare eligibility and 6 years before their Social Security full retirement age. From there, the foundation of their plan is this: $7,000 per month in after-tax spending. This is the number Bill and Tina gave us. They felt confident this amount would cover all their day-to-day living costs, groceries, utilities, insurance, entertainment, and still give them breathing room for unexpected expenses. Next was travel. They budgeted $15,000 per year. Not necessarily exotic destinations, but the freedom to visit family and start taking more trips. Healthcare was a major factor. Since they'd be retiring before Medicare eligibility at 65, they'd need private insurance. We estimated this at about $1,000 per person per month until they reach Medicare age. This is an expense that can catch many couples off guard when they're planning for retirement. These weren't just numbers. They're the first step in our process, which is determining their retirement vision. But having a vision and having a plan to fund it are two different things. Let's look at how Bill and Tina's income changes as they transition into retirement. Understanding their income sources is the foundation for determining how much they may be able to safely spend. Right now, Bill brings in $180,000 annually. But one challenge with retiring at 61 is that those paychecks would stop 6 years before their Social Security full retirement age. The good news is that Social Security is going to provide a solid foundation later in retirement. When Bill turns 67, he'll receive about $3,500 per month. Tina will receive $2,200 per month at the same age. Together, that's $5,700 per month in guaranteed income. Substantial support, but not until they reach full retirement age. So now we have an idea of what income they will have coming in throughout retirement. But this income won't be enough to cover their retirement. The rest will need to come from their portfolio. And to find out how much more they're going to need, we need to map out their year-by-year financial reality. This is the cash flows page. One of the most important tools we use to test the strength of any retirement plan. This gives us a way to compare what's coming in, what's going out, and how much we're going to need to pull from the portfolio over time. We'll walk through it left to right, just like you'd read it. Let's start with what's coming in. You can see that from 2026 through 2031, ages 61 through 66, there's a zero in every single row under income inflows. No salary, no Social Security, no pension. 6 years of complete dependence on their portfolio. But look what happens in 2032 when they both turn 67 and Social Security begins. You'll see the income jumps to about $73,000 annually. That's when their Social Security benefits finally kick in. From that point forward, they have over $6,000 per month in guaranteed income. But look at this gap, 2026 through 2031 with zero guaranteed income. That's what makes retiring at 61 so challenging and why spending uncertainty scared them so much. Now, let's shift to what's going out. Bill and Tina's core lifestyle expenses started around $108,000 in year 1, growing to about $119,000 by year 10. That's their $7,000 per month target, plus healthcare costs, plus inflation adjustments. Even at a modest inflation rate, their $7,000 monthly need becomes $8,800 per month by their mid-70s. Then there are their goals. $15,000 per year for travel, adjusting for inflation. This gives them the flexibility to visit family, take trips, and not worry about vacation constraints. Now, let's talk about the tax situation. In the early years, with no work income and smart withdrawals from different account types, taxes are manageable, around $13,000 annually. Interestingly, taxes actually decrease slightly over time as they optimize their withdrawal strategy. We'll dive deeper into strategies to minimize taxes in another video, but this gives us the baseline for planning purposes. So where does this leave us? Each row ends with the most important number, net flows. This is the amount that Bill and Tina need to pull from their investment portfolio each year. Year 1 of retirement, $136,000 comes out of their portfolio. That's more than most people's annual salary, and it has to come out whether markets are up or down, which is exactly why I wanted to make sure they were spending the right amount. And that continues for 6 full years. Year after year, they're taking out between $132,000 and $152,000 annually. That's a substantial amount that their portfolio needs to provide consistently. But look what happens when Social Security kicks in starting in 2032. Those withdrawals drop dramatically to around $66,000 per year. That's the power of having guaranteed income to reduce the pressure on their portfolio. So now, we knew exactly what Bill and Tina needed to pull from their portfolio each year, which is the second step of our process. But knowing the dollar amount and knowing whether it's sustainable are two different things. Therefore, we needed to analyze whether these withdrawal amounts represented a healthy rate they could maintain for decades. This chart shows what we call withdrawal rates. It goes year by year and shows how much they need to take out of their portfolio compared to what they have. It's like checking the pulse of their retirement plan. Let's start on the left, their first 6 years of retirement. You can see they'll need to take out between 8% and 9% of their portfolio each year during this critical period. This is a lot to take out, especially when you consider that many experts often prefer seeing this number closer to 4%. Think about it like this. You want to take out less than what's growing back each year. If markets average 7% returns, but you're taking out 8 or 9%, you might be dependent on good market timing if you want your money to last. But watch what happens when Social Security begins at age 67. The withdrawal rate drops dramatically to around 4%, right in line with those safe guidelines. That guaranteed income of $6,000 per month takes enormous pressure off their portfolio. And from age 67 onward, it stays right around that 4% number for the remainder of the plan. This told a promising story. High withdrawal rates early on, but dropping to sustainable levels once Social Security kicked in. But withdrawal rates assume the same returns every year, and markets almost never cooperate that nicely. Therefore, we needed to test what happens when reality doesn't match the projections. What happened next changed everything about how they think about spending money in retirement. We ran Bill and Tina's baseline plan, retiring at 61 with $7,000 monthly expenses and $15,000 of annual travel through 1,000 different market scenarios. Basically, testing their plan against every possible combination of good and bad markets, crashes, recoveries, inflation spikes, everything. The result? A 100% chance their plan works. That means In all 1,000 scenarios, they never ran out of money. And with a projected ending portfolio value of over 1.5 million, the 100% success rate answered that last little bit of doubt in the back of their mind. They could retire. But even after Bill saw that number, he still had concerns. What if we got our expense numbers wrong? What if we need $8,000 or $9,000 per month instead of $7,000? What if we retire and realize our expenses are higher than we thought? This was actually a critical test. One of the most common mistakes we see is incorrectly estimating what people will actually spend in retirement. Many couples either don't have a tight grasp on their expenses or don't know how they'll change in retirement. So to test this, we increased their monthly spending from $7,000 to $9,000, an extra $2,000 per month for unexpected costs, home maintenance, or simply a more comfortable lifestyle. In that $9,000 monthly, the success rate dropped to 67%. Bill and Tina could see how big of an impact getting their spending right has on the plan. Just $2,000 extra per month reduced their plan's reliability from bulletproof to concerning. You could see this reality check sink in. Bill said, "I guess we need to be really careful about that 7,000 number." This showed them that getting your spending right can have just as big of an effect on a successful retirement as your portfolio does. But here's the test that really opened their eyes. We showed them something that many advisors don't show couples. Bill and Tina had been investing since they were teenagers and really understood how the market can behave. They were always okay with watching their portfolio bounce up and down because they knew this was normal when you invest. So we showed them a projection that had a different portfolio, one that was a little bit more aggressive and may have more fluctuation. This change increased their expected returns from 6% to 7% annually by adding slightly more growth investments to their portfolio. This wasn't about chasing hot investments. It was about seeing how changing how their money is invested might change their results. The result? 98% chance their plan works. A very similar but slightly lower probability than their baseline due to the added risk. But this projection had a significantly different outcome that many people might miss. Take a look at their projected ending balance. With that added risk came slightly higher expected returns, and they're now projected to end with over 2.2 million instead of 1.5 million. That's an extra $700,000, money that could support higher spending, more travel, or just provide additional security. But when we showed this, we made sure Bill and Tina understood the trade-off. Higher expected returns means more market ups and downs. They could do better over the long term, but if they faced a big market downturn early in retirement, they might be forced to cut back on their spending temporarily while the market recovered. Bill and Tina were starting to see they had more control than they thought. But the real insight was still coming. That's when Tina asked the question that tied everything together. If we're comfortable with that slightly higher risk, how does that $8,000 per month of spending look versus the $7,000? So we tested the sweet spot, a little bit more risk in the portfolio that would allow us to project a 7% return, but an increase in the monthly spending from $7,000 to $8,000 per month. With $8,000 monthly spending and moderate risk, 91% chance their plan works. Still excellent reliability, but with a bigger cushion for their monthly expenses. They'd still end with nearly $1.5 million, proving they could potentially afford a more comfortable lifestyle while maintaining strong plan security, if they were okay taking a little bit more risk. This testing is the third step in our process, and what it revealed wasn't just numbers. It was education and empowerment. We used these scenarios to help Bill and Tina understand exactly what factors could affect their retirement success and give them the power to use their savings in a way that best aligned with their values and their risk tolerance. Through this process, Bill and Tina learned that nailing down their spending really matters. $2,000 extra per month could make the difference between a bulletproof plan and a concerning one. They learned that taking slightly more investment risk could provide significantly more long-term wealth, but required accepting more short-term volatility. Most importantly, they learned they had choices, and the testing gave them the clarity to make those choices confidently. What they felt was the best plan for their specific situation: $8,000 monthly spending with moderate investment risk, the one with a 91% chance that their plan would work. But the real value wasn't in finding the perfect number. It was in understanding how different decisions would affect their outcomes. If this changed how you think about spending in retirement, subscribe for more insights like this one. We make videos every week that can change your perspective on retirement. Thanks for watching, and we'll see you in the next one.